Welcome to Belhaven University Lectures. What you are about to hear is a podcast based on course material selected by the course developer. It was generated by Google Notebook LM, a generative AI. Please contact your instructor if you have any questions related to the content. Okay, let's get started.
Ever get that nagging feeling after filing your taxes that you might have left some money on the table? Maybe overlooked some legitimate ways to reduce what you owe.
It happens to a lot of people. Tax rules can be complex.
Exactly. So today we're doing a focused exploration, a deep dive, really into deductions and losses. We're zeroing in on certain itemized deductions and also the tricky bits around employee versus self-employed expenses.
Think of it as trying to map out some key paths through what can feel like a dense forest of regulations.
Right. The goal here is to help you, our listener, get a quicker, clearer understanding of what personal and business expenses might actually be deductible. We want those aha moments, but without the information overload.
Precisely. We've looked at excerpts, chapters covering itemized deductions, and these employee or self-employed expenses.
And our mission really is to pull out the practical knowledge, the kind of stuff that could directly impact your financial situation come tax time. Ready to jump in?
Let's do it. Maybe we should start with a core concept. The difference between itemized deductions and deductions for adjusted gross income, or AGI.
Good idea. Itemized deductions.
Yeah.
Those are specific personal expenses, right?
Yeah.
Like if you add them all up and they're more than the standard deduction, you might choose to itemize.
That's the gist of it. And the sources point to the main categories here. Medical costs, certain taxes you pay, mortgage interest, and charitable donations.
Okay, those sound familiar, but it's a choice, isn't it? Standard deduction or itemizing? Usually not both.
Generally, yes. You pick the one that gives you the better result. Now, deductions for AGI are a bit different.
How so?
They get subtracted before you even calculate your adjusted gross income. AGI is a really important number because it affects eligibility for lots of other tax things.
Okay, so they come off the top, so to speak.
Exactly. And a key example our material gives is contributions to a traditional IRA. That's deductible for AGI.
Meaning you can take that deduction even if you end up taking the standard deduction later.
Precisely. It's independent of that itemizing decision.
Understood. That helps clarify the two types. So let's dig into some specific itemized categories. Medical expenses first. That can be a big one for people.
It certainly can. Now, the source material doesn't give like a super precise definition of medical expense,
Okay.
but it does tell us what usually does not count. Things like cosmetic surgery just to improve appearance.
Right. Makes sense. Elective stuff.
Yeah. And also general health things, vitamins, non-prescription drugs, that sort of thing. Usually not deductible.
But what if cosmetic surgery is medically needed, say after an accident?
Oh, good question. And yes, there's a key exception mentioned. If the surgery is necessary to, say, correct a deformity from birth or an injury or a disfiguring disease, then it can be deductible.
So the reason for the surgery is crucial.
Exactly. It's all about the primary motivation.
Okay. What about really big expenses like nursing home care or special schools?
For nursing homes, it depends why the person is there. If the main reason is medical care, then the costs, including meals and lodging at the facility, can qualify.
But if it's more for personal or custodial reasons?
Then generally, only the specific costs directly for medical treatment are deductible, not the room and board part.
That distinction seems really important. And special schools for kids with specific needs.
Yes, the sources say tuition for a special school for someone with mental or physical handicaps can be included in medical expenses. If a main reason for sending them there is the school's special resources for helping with their condition. And in that case, meals and lodging provided by the school might also be deductible along with the tuition.
Interesting. The tax code does seem to recognize these specific situations. Sometimes medical care requires travel too. What about those costs? Transportation, lodging.
Transportation costs to get medical care are generally deductible. So plane tickets, taxi fare, using your own car for that purpose. Lodging is a bit more limited. If you have to travel away from home for outpatient care, there's a deduction, but it's capped.
Capped at how much?
At $50 per night, per person. That's for the patient, and also for a companion if their travel is medically necessary.
And the Williamson example from the source illustrates this, right? Their trip to Cleveland.
Exactly. John and Martha went for Martha's heart treatment. Their airfare was $500 total, $250 each. That full $500 is deductible as transportation.
Okay, and their hotel.
They paid $120 a night for 2 nights, so $240 total. No, wait, $120 per night, so $480 total for 2 nights. But the deduction is limited. It's $50 per night for Martha and $50 per night for John if his being there was medically necessary.
So $100 per night total times 2 nights.
Means a $200 lodging deduction, even though they spent $480. That $50 per night limit is a key detail.
Definitely. What about health insurance premiums themselves, paying for the coverage?
Yes, premiums for medical care insurance do count as a medical expense, but like other medical expenses, they're subject to that AGI floor, meaning you only deduct the amount that exceeds a certain percentage of your adjusted gross income.
Okay, so subject to limitations. Is it different for self-employed people?
It is, significantly. Self-employed individuals can generally deduct the premiums they pay for health insurance for themselves, their spouse, and dependents as a business expense. This is a deduction for AGI.
Which is usually better, right?
Much better, yes. It comes off before AGI is calculated. But there's a catch. You can't take this deduction if you or your spouse were eligible to participate in an employer-sponsored health plan.
Got it. That's a crucial point for freelancers or small business owners. And long-term care insurance premiums.
Those can also be included as medical expenses, but again, there are limits. And these limits actually depend on the age of the person insured.
Age-based limits.
Yeah. For 2024, the source says they range from $470 if you're 40 or under, up to $5,880 if you're over 70.
Wow, okay. So lots of specifics there. When do you actually deduct these medical costs? The year you get the service or the year you pay the bill?
Generally, it's the year you pay. Most individuals use the cash basis of accounting, so it's when the money leaves your pocket.
So prepaying for next year's surgery won't work?
Usually not. You generally can't deduct prepayments for services you'll receive in a future year unless there's some kind of binding obligation to pay up front.
Makes sense. Prevents people from trying to load up deductions. The sources also mentioned health savings accounts, HSAs. How do they fit in?
HSAs are linked to high-deductible health plans. They're a way to save and pay for healthcare tax-free, essentially.
High deductible plan. What qualifies in 2024?
The minimum deductible is $1,600 for self-only coverage, $300 to $200 for family. And there are limits on total out-of-pocket expenses too, $8,050 for self, $16,100 for family.
And you can contribute to the HSA and deduct it.
Yes, contributions are deductible for AGI. For 2024, the limits are $4,150 for self-only, $8,300 for family coverage. Withdrawals are tax-free if used for qualified medical expenses.
So HSAs offer a trade-off. Higher deductible insurance, but tax advantages on saving and spending for healthcare.
Interesting. Okay, let's shift gears to another big itemized deduction category. Taxes.
Right. And the first thing is defining what a tax even is for deduction purposes.
It's not just any payment to the government.
No. The source defines it as an enforced contribution for public purposes. It's distinct from a fee you pay for a specific service or privilege.
Okay. So what taxes are not deductible on your federal return?
Well, federal income tax itself isn't deductible. Neither are federal estate or gift taxes. And generally, federal, state, or local excise taxes aren't deductible either. Think gasoline taxes.
So what can we deduct?
The main ones are state and local taxes. Specifically, you can choose to deduct either your state and local income taxes or your state and local general sales taxes, not both.
The income versus sales tax choice.
Yes, and you could also deduct state and local real estate taxes and state and local personal property taxes.
Personal property taxes, like the tax on a car. Exactly, but only if it's based on the value of the property. The Williamson example clarifies this well. They paid $412 for car registration.
Okay.
$400 of that was based on the car's value, like 2% of $20,000. The other $12 was based on the car's weight.
So only the value-based part counts.
Right. Only the $400 is deductible as a personal property tax. The $12 weight-based fee isn't.
That value-based distinction is key. What about real estate taxes when a house is sold mid-year? Who gets the deduction?
That gets apportioned. The taxes for the whole real estate tax year are split between the buyer and seller based on how many days each own the property during that specific tax year.
So it doesn't matter who actually wrote the check to the county?
Not for deduction purposes, no. It's based on the ownership period. The settlement statement usually shows this allocation.
Got it. Now, back to that income versus sales tax choice. How does that work?
You basically figure out which amount is higher for you in that year, the state local income tax you paid, or the state local sales tax you paid. You deduct the larger amount.
You can use actual sales tax receipts or...
Yeah. Or you can use optional sales tax tables provided by the IRS, plus add-on sales tax paid on certain large purchases like cars or boats. The Jaspin example in the source shows someone choosing the sales tax deduction because it was higher than their state income tax paid.
Okay, so you compare and pick the better one.
Yeah.
But isn't there an overall limit now?
Yes, a very important one. The total amount you can deduct for all state and local taxes, whether that's income or sales tax plus property taxes, is capped at $10,000 per household per year.
Just $10,000 total for everything.
$10,000 total, yes. That's a significant limitation introduced a few years ago.
Definitely something to remember. Okay, moving on to another potentially large deduction, interest expense. Again, not all interest is deductible, right?
Correct. The big one for personal deductions is qualified residence interest.
Meaning mortgage interest.
Yes. Interest on debt secured by your main home and potentially one other second home. This includes acquisition indebtedness loans to buy, build, or substantially improve the home. It also used to clearly include home equity loan interest, but now that's limited.
Limited how?
Generally, home equity loan interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home securing the loan. And there are limits on the total amount of mortgage debt eligible for the interest deduction.
Okay, so mortgage interest with some rules. What about interest on, say, credit cards or car loans?
Generally, no deduction for personal interest like that.
Are there other types of interest that are deductible?
Yes. Investment interest on loans used to buy investments like stocks can be deductible, but it's limited to your net investment income for the year.
So you can't deduct more investment interest than you earned in investment income.
Pretty much, yes. And importantly, you can't deduct interest on debt used to buy tax-exempt investments like municipal bonds.
That makes sense. You don't get a deduction for borrowing to earn tax-free income. What about things like prepayment penalties on loans?
Those are generally treated as interest and are deductible in the year paid.
And loans between family members.
Yep.
Can you deduct interest paid to, say, your parents?
Only if it's a bona fide debt. There has to be a real expectation and intent for the loan to be repaid, usually with a formal agreement, interest rate, and repayment schedule. The IRS looks closely at family loans.
Needs to be legitimate, not just a gift disguised as a loan.
Exactly.
When is interest deductible? The year it's paid.
For most people using the cash method, yes, it's deductible when paid. Accrual method, taxpayers deduct it as it accrues over the loan term. And importantly, you generally can't prepay interest for future years and deduct it all now. Prepaid interest usually has to be allocated to the year it actually applies to.
So you deduct it over time as it's due. The source also mentions classifying interest, whether it's for AGI or itemized. What determines that?
It depends on what the loan was for. If the debt is related to a trade or business, or for generating rent or royalty income, the interest is usually deductible for AGI.
Okay.
But if it's personal, like qualified residence interest, it's an itemized deduction. Except for student loan interest. That's a specific exception. Qualified student loan interest is deductible for AGI up to a limit, regardless of whether you itemize.
Good to know. Okay, let's shift gears significantly now into the world of employee versus self-employed expenses. This area feels like it has a lot of nuances.
It really does, and the fundamental difference has huge tax implications.
Okay.
For self-employed folks, their ordinary and necessary business expenses are deductible for AGI, typically on Schedule C. For employees, their unreimbursed business expenses used to be miscellaneous itemized deductions.
Used to be.
Yes, key point. That deduction for most miscellaneous itemized expenses, including unreimbursed employee business expenses, was suspended for tax years 2018 through 2025.
Suspended. So for now, most employees just can't deduct things like unreimbursed travel, supplies, home office use.
Generally, that's correct. It's a major change. Unless they fall into very specific categories, regular W-2 employees don't get a federal tax break for those expenses right now.
Wow. Okay, so that makes the distinction employee versus self-employed even more critical. What determines that classification?
It boils down to control, really. The source lists factors suggesting an employer-employee relationship. Does the employer provide tools and a place to work? Do they provide training? Do they offer benefits like health insurance? Are they paid based on time worked rather than by the job?
The more yeses to those, the more likely they're an employee.
Generally, yes. More control by the payer points towards employee status. Independent contractors or self-employed individuals typically have more control over how, when, and where they do their work.
And businesses often issue a Form 1099 NEC to contractors, right?
Correct. If you receive a 1099 NEC reporting income paid to you for services, that's a strong indicator the payer considers you self-employed, an independent contractor. You'd report that income and your related expenses on Schedule C.
Okay. But there's also this category called statutory employees. What's that about?
Ah, yes. It's a bit of a hybrid. These are specific types of workers, certain drivers, full-time insurance agents, some home-based workers, certain traveling salespeople who are treated as employees for Social Security and Medicare taxes.
Okay.
But they get to deduct their allowable business expenses for AGI on Schedule C, just like a self-employed person.
So kind of the best of both worlds in that respect. Pay employment taxes, but deduct expenses for AGI.
In a way, yes. Their income isn't usually subject to income tax withholding, though.
Interesting category. All right, let's talk specific business expenses, starting with transportation. What qualifies?
This is about the cost of getting from one business location to another business location when you're not traveling away from home overnight. Think taxi fares, using your car for business, tolls, parking related to those business trips.
But not the regular commute from home to your main job.
Generally, no. Commuting is considered personal and non-deductible.
Are there exceptions? I think the source mentioned one related to a home office.
Yes, exactly. If you have a qualifying home office, that is your principal place of business.
Which is?
Meaning it's used exclusively and regularly for managing your business, and you don't have another fixed location where you do those main administrative tasks. Then travel from that home office to other business locations like visiting clients is deductible. It's not considered commuting.
Like Morgan in the example, traveling from her home office to tutoring clients.
Precisely. Her home office was her principal place of business for tutoring.
Okay. Now, for using your own car for business, there are two ways to deduct the cost, right? Standard mileage or actual expenses.
Correct. The standard mileage rate method is often simpler. For 2024, it's 67 cents per business mile. You just need to track your business mileage carefully. Plus, you can still deduct business-related parking and tolls separately.
And the other way, actual costs.
That involves tracking everything: gas, oil, repairs, insurance, depreciation, lease payments if applicable, all the actual costs of operating the car. Then you allocate those costs based on the percentage of miles driven for business versus personal use.
That sounds like more record keeping.
Definitely. You need receipts and detailed records for the actual cost method. The standard mileage rate requires good mileage logs but less tracking of every single expense. Morgan, in the example, used the standard rate because she didn't have cost basis info for the car.
And keeping those mileage logs, what's needed?
The IRS wants contemporaneous records, meaning you log it at the time or close to it. Date, destination, business purpose, miles driven.
Apps can help with that now, can't they?
Oh, absolutely. The source mentions several apps like MileIQ, TripLog, QuickBooks Self-Employed, Stride Drive. Many use GPS or Bluetooth to track drives automatically. You just need to classify them as business or personal and note the purpose.
Makes it much easier. Let's do a quick calculation from the source. Kalia drove 17,800 business miles and 8,600 personal miles in 2024 using the standard rate.
Okay, 17,800 business miles times 67 cents per mile. That comes out to 11,926 cents for the deduction. The personal miles don't count, of course.
11,926 governance. Got it. Now let's distinguish transportation from travel expenses.
Yeah.
How are they different?
Travel expenses are incurred when you're away from your tax home overnight for business. That overnight piece is key.
Tax home. That's not necessarily where you live.
Not always. It's generally your main place of business or work, the general area. Being away from home overnight means your duties require you to be away substantially longer than a normal workday, needing sleep or rest to meet the demands of your work.
And travel expenses include more than just getting there.
Right. It includes the transportation, but also lodging, meals, though meals are usually only 50% deductible, and incidental expenses while you're away on business.
Are there limits on deducting travel, like for conventions or education?
Yes. For conventions, the trip must be directly related to your trade or business. You can't just deduct a trip to a fun location because a convention happens to be there if it's not relevant to your work.
Makes sense.
And travel as education itself is generally not deductible. But if you travel for education that is deductible, like maintaining job skills, then the travel costs might be deductible too.
What about trips that mix business and pleasure, especially international ones?
For domestic travel within the U.S., if the primary purpose is business, you can deduct the transportation costs fully, but only the lodging and meals for the business days. If primary purpose is pleasure, no transportation deduction.
And foreign travel.
It's often allocated. You look at the number of business days versus personal days, transportation costs might be prorated based on that ratio. The Rafael example going to China illustrates this. 9 business days out of 11 total days meant he could deduct 911ths of his airfare.
Okay, so allocation is key for foreign trips. And record keeping is crucial for all travel, I assume.
Absolutely essential. Dates, places, amounts, business purpose. You need solid documentation for travel expenses.
Right. Let's talk education expenses now. When can a self-employed person deduct the cost of education?
2 main reasons. Either the education maintains or improves skills needed in their current job or business, or it's required by law or regulations to keep their current license or status.
So continuing education to stay current.
Yes, that often qualifies.
What doesn't qualify?
Education needed to meet the minimum requirements for your job doesn't count. And crucially, education that qualifies you for a new trade or business is not deductible.
Like the example of the accountant getting a law degree.
Exactly. That qualifies them for a new profession. So the law school costs aren't deductible as a business expense for their accounting practice. Morgan's master's degree in the example wasn't deductible for her tutoring driving business either. It might qualify for education credits, though, which is different.
Credits versus deductions again. If the education is deductible, what costs are included?
Tuition, fees, books, supplies. Also transportation costs, like driving from work to night school. And maybe even travel expenses, lodging, meals, if you have to go away overnight for deductible education.
But not fees for professional exams, like the CPA or bar exam.
Generally, no, according to the source material activity. Those are usually seen as qualifying you for a new profession or meeting minimum requirements.
Okay. Let's move to the home office deduction. Big topic for self-employed folks.
Very relevant. But first, the big caveat we mentioned. For employees, this deduction is suspended from 2018 through 2025. So right now, this is primarily for the self-employed.
Got it. So for a self-employed person, what are the requirements?
You need a space used exclusively and regularly for business. And it generally needs to be either your principal place of business or a place where you physically meet with clients or customers in the normal course of business.
Principal place of business.
Yeah.
What does that mean if you work from home but also sometimes meet clients elsewhere?
It can still qualify if your home office is where you conduct your main administrative or management activities and you don't have another fixed location where you regularly do that stuff, like you do your billing, scheduling, record keeping there.
Okay. Exclusive and regular use and principal place of business or client meetings. How do you calculate the deduction? There are 2 methods.
Yes. The regular method and the simplified method.
Regular method first.
That involves calculating the actual expenses of your home, rent, or mortgage interest, and property taxes, insurance, utilities, repairs, depreciation if you own, and then allocating a portion of those expenses to your office space.
Based on square footage.
Usually, yes.
Yeah.
You figure out the percentage of your home's total square footage that the office occupies. Direct expenses, like painting just the office, are fully deductible. Indirect expenses, like utilities, are allocated.
Is there a limit?
Yes, the deduction can't create a business loss. It's limited to the gross income from the business use of the home. Any excess can be carried forward.
Okay, that's the regular method. What's the simplified one?
Much easier calculation. You just take the square footage of your home office up to a maximum of 300 square feet and multiply it by $5.
So a maximum deduction of $1,500. 5 by $300 SQF.
Exactly. It's simpler, less record keeping for actual expenses, but it might result in a smaller deduction. And you can't carry forward any unused amount. Also, if you use the simplified method, you don't get a separate deduction for the allocated portion of things like mortgage interest or property taxes that are part of the $5 rate.
So pros and cons to each. Let's use Morgan's apartment example. 1,200 square foot total, 200 desk quit office, expenses of $18,700, rent, utilities, insurance.
Okay, the office is $200,100, which is 16th of the apartment space.
So under the regular method,
You'd take 16th of her $18,700 total expenses. That comes out to $3,116.67. Let's say $3,107.
and the simplified method,
Her office is 200 desk square foot. 200 times 5 is $1,000.
big difference.
Yeah.
$3,117 versus $1,000.
In her case, yes. The regular method is clearly better, assuming she has the records for her expenses. She'd then allocate that $3,117 between between her tutoring and driving businesses.
Really shows you need to run the numbers both ways if you can.
Yeah.
Okay, quickly, what about some other expenses mentioned? Moving expenses.
Suspended for 2018-2025, except for certain military moves.
Entertainment. Club dues.
Generally not deductible anymore. Club dues are out. Entertainment, amusement, recreation expenses, largely non-deductible.
What about business meals?
There's still potential for deducting 50% of the cost of business meals, provided they meet certain criteria like not being lavish, taxpayer, or employee present, provided to a current or potential business contact.
Okay. Business gifts.
Still deductible, but limited to $25 per recipient per year.
And things like union dues, professional licenses, work uniforms for employees.
Those fall under the suspended miscellaneous itemized deductions subject to the 2% floor, so generally not deductible for employees right now, 2018-2025.
What about teachers buying classroom supplies?
Ah, yes, the educator expense deduction. Eligible K-12 educators can deduct up to $300, that was the 2023 amount, might adjust slightly, of unreimbursed costs for books, supplies, etc. This is an above-the-line deduction for AGI.
So that one survived the suspension for employees. Good to know. Now, for the self-employed folks listening, the Qualified Business Income Deduction, QBI, sounds important.
It is. Potentially quite significant. It allows eligible self-employed people and owners of pass-through businesses like partnerships and S-Corp to potentially deduct up to 20% of their qualified business income.
20%. That's substantial. How is it limited?
The deduction is generally the lesser of 20% of your QBI, or 20% of your taxable income calculated before the QBI deduction. And it's a deduction for AGI.
Okay, what counts as qualified business income, or QBI?
It's basically the net profit from your qualified trade or business conducted in the U.S., income from services, sales, rents related to the business.
What's excluded?
Things like investment income, capital gains, dividends, most interest, wages earned as an employee, and guarantee payments to partners are generally not QBI. You also have to reduce QBI by certain deductions like half of self-employment tax, self-employed health insurance premiums, and retirement plan contributions.
So, net business profit with some adjustments. And what's a qualified trade or business?
Below certain income thresholds, it's very broad, basically any business other than being an employee. Above those thresholds, though, certain specified service trades or businesses face limitations or phase-outs.
It's like doctors, lawyers, accountants.
Yes, health, law, accounting, consulting, financial services, performing arts, athletics, fields where the main asset is the skill or reputation of the people involved. But again, those limitations mainly kick in above certain income levels.
Okay, let's use Morgan's example again. She had $3,910 net income from tutoring, $2,283 from driving. So her QBI is
$3,910 plus $2,283 from $6,193 total QBI.
And let's say her taxable income before QBI was $52,000, no capital gains. How's the deduction calculated?
Okay, step one. 20% of her QBI, $6,193, is $1,238.60.
Got it.
The QBI deduction is the lesser of those two amounts. So her deduction is $1,238.60.
That walks through it clearly. Finally, just a quick touch on retirement contributions and those accountable plans. IRA contributions?
Contributions to a traditional IRA are generally deductible for AGI, up to the limit, $7,000 for 2024 or $8,000 if you're 50 or older. Same goes for contributions to self-employed plans like SEPs, Simples, solo 401ks.
But not Roth IRAs.
Correct. Roth contributions aren't deductible up front, but qualified withdrawals in retirement are tax-free.
And accountable versus non-accountable employee reimbursement plans. What's the difference?
It's about how employers handle expense reimbursements for employees. An accountable plan requires employees to adequately substantiate their expenses, receipts, logs, and return any excess reimbursement.
They have to do that.
The reimbursement isn't counted as income to the employee, and the employee doesn't deduct the expense. It's basically a wash on their tax return.
And a non-accountable plan.
That's where the substantiation or return of excess rules aren't met. In that case, the reimbursement is included in the employee's taxable wages on their W-2.
And the expenses they incurred.
They're treated as unreimbursed employee expenses, which, as we said, are generally not deductible for employees from 2018-2025 due to the suspension of miscellaneous itemized deductions.
So being in an accountable plan is definitely better for the employee currently.
Absolutely. It avoids having the reimbursement taxed and then not being able to deduct the expense.
Wow. Okay, this has been incredibly detailed. It really hammers home that navigating deductions takes, well, careful attention and good records.
It really does. The rules can seem daunting, but understanding these distinctions deductible versus non-deductible, personal versus business, AGI versus itemized, and keeping those records can make a real difference to your tax liability.
And hopefully this deep dive gave you, our listener, a solid overview of some key areas based on the sources we looked at. We definitely encourage you to think about how this applies to your own situation.
And maybe consider talking with a tax professional for advice specific to you. Tax laws change, and personal situations vary so much.
Definitely good advice. So we'll leave you with a final thought to ponder. Knowing these principles about deductions, especially with the tax landscape always shifting, how can that understanding empower you to make smarter financial decisions all year round, not just when April rolls around?
Something to think about. It's more than just filing, it's about planning.